Hello viewers, welcome to Point of Earning. In this video we will discuss about the reversal bar pattern. What does it mean and how to trade in this pattern. Okay, now let's get started. Reversal bar pattern. A bullish reversal bar pattern goes below the low of the previous bar before closing higher. A bearish reversal bar pattern goes above the high of the last bar before closing lower. Now, what does it mean? For the bullish pattern, the market found support below the low of the previous bar. Not only that, the support was strong enough to push the bar to close higher than the previous bar. This is the first sign of the possible bullish reversal. For the bearish pattern, the market met resistance above the high of the previous bar. Furthermore, the resistance was powerful enough to cause the current bar to close lower. How do we trade it? Buy above the bullish reversal bar in an uptrend. Sell below the bearish reversal bar in a downtrend. Key reversal bar pattern. What does it look like? A key reversal bar is a particular instance of a reversal bar that shows clear signs of the reversal. A bullish key reversal bar opens below the low of the previous bar and closes above its high. A bearish key reversal bar opens above the high of the previous bar and closes below its low. By definition, key reversal bars open with a price gap. As gap within intraday time frames are rare, you will find most key reversal bar in the daily and above time frames. What does it mean? A down gap is a powerful down thrust when the market rejects such a strong bearish move with certainty. It might have reversed its sentiment to bullish. On the other hand, when a gap upward bumps into clear resistance, the market might have turned bearish. Essentially, a key reversal bar is a violent display of strength that hints at a change of market sentiment. How do we trade it? By above a bullish key reversal bar. If uncertain, wait for the price to close above it before buying. Sell below a bearish key reversal bar. If unsure, wait for the price to close below it before selling. Exhaustion bar. What does it look like? A bullish exhaustion bar opens with a gap down, then it works its way up to close near its top. A bearish exhaustion bar opens with a gap up before moving down to close is a bearish bar. In both cases, the gap remains unfilled. Also, high volume should occur with the exhaustion bar. What does it mean? Its name explains it all. It represents exhaustion and a failed last-ditch attempt. After the bears are exhausted, the bulls will take over and the market will rise. After the bulls are exhausted, the bears will take in the market down. How do we trade it? Buy above a bullish exhaustion bar. Sell below a bearish exhaustion bar. Two bar reversal. What does it look like? The two bar reversal pattern is made up of two strong bars closing in opposite directions. The bullish variant consists of a strong bearish bar followed by a bullish bar. Reverse the order to get its bearish counterpart. What does it mean? Every reversal pattern works on the same premise. A clear rejection of a downward thrust is a bullish reversal, and a clear rejection of an upthrust is a bearish reversal. In this case, the first bar represents the first thrust and the second bar represents its rejection. How do we trade it? For bullish reversal, buy above the highest point of the two bar pattern. For bearish reversal, sell below the lowest point of the two bar pattern. Three bar reversal. What does it look like? In sequence, the three bar of the bullish patterns are a bearish bar. A bar has a lower high and lower low. A bullish bar with a higher low and closes above the high of the second bar. Accordingly, the bearish pattern is made up of a bullish bar. A bar has a higher high and higher low. A bearish bar with a lower high and closes below the low of the second bar. What does it mean? A three-bar reversal pattern shows the turning point compared to the other reversal patterns. The three-bar reversal pattern is the most conservative one as it extend over 3 bars, using the third bar to confirm that the market has changed its direction. How do we trade it? Buy above the last bar of the bullish pattern. Sell below the last bar of the bearish pattern. 3 bar pullback. What does it look like? This bar pattern is easy to identify. 3 consecutive bearish bar from a bullish pullback pattern and 3 consecutive bullish bar from a bearish pullback pattern. What does it mean? When the market is trending, it's hard to sustain a counter trend pullback. Hence, after a pullback of 3 bars, the trend is ready to resume. How do we trade it? Within a bull trend, wait for 3 consecutive bearish bars, then buy above the next bullish bar. Within a bear trend, wait for 3 consecutive bullish bar, then sell below the next bearish bar. Inside bar. An inside bar must stay completely within the range of the bar immediately before it. In other words, the second bar must have a lower high and a higher low. What does it mean? An inside bar is a contraction in price range volatility. Within the same unit time, the market covers less ground and stays completely within the range of the previous bar. It is a pause in price action and does not show clear strength in either direction. How do we trade it? Place bracket order around it to trade its breakout in either direction. Place only one order, buy or sell according to the market trend. Wait for a breakout of the inside bar and trade its failure. Outside bar. An outside bar pattern is the polar opposite of an inside bar. Its range must exceed that one of the previous bar with a higher high and a lower low. It is a short-term expansion in price range. It shows strength in both directions. In most cases, it is uncertain if the bulls or the bears have won. The only certainty is the increased volatility. How to trade? Wait for a breakout of the outside bar and fade it, especially for outside bar that look like dodges or those that go against the trend. Trade its breakout especially when the outside bar closes near its top or bottom. And 7 bar. This bar pattern requires 7 bars. If the last bar has the smallest bar range within time sequence, it is an NR7 pattern. To clarify, bar range refers to the difference between the high and the low of a bar. What does it mean? Like the inside bar, it indicates decreasing volatility. As the lower volatility comes within the context of 7 bars instead of a single bar like in the case of an inside bar, the NR7 pattern is a stronger sign of decreasing volatility. However, while the inside bar shows no strength in either direction, the NR7 pattern might drift upward or downward. In such cases, the NR7 represents price thirst with decreasing volatility. How it works? How to trade? Buy breakout of the high of the last bar if the trend is up. Sell breakout of the low of the last bar if the trend is down. 2 bar reversal, also pipe formation. Bukowski described the horn pattern as being almost identical in behavior to the pipe except a smaller bar separates the two lengthy bars. The two long bars become the horns of the formations. 2 bar reversal, the formation is more reliable with weakly bars and otherwise has the same characteristics as the pipe. It's not as effective as the pipe at bottom and tops, and its failure rate increases when the trend preceding the pattern is short. Horn pattern. In the bottom pattern, the first bar usually closes in the lower half of the bar and the second bar closes end near its high. Usually high volume is seen on both bars. In its extreme and more reliable version, it consists of two side-by-side spikes, but it can also be above average length sides by side bars of roughly equivalent length peaking or bottoming at close to the same price and occurring after a lengthy trend. It is preferable for the second bar to be slightly longer than the first bar. The volume is preferably higher on the left bar than on the right. Many pipes occur at the end of the retracement of a longer term move. The directional clue is the direction of the breakout from it.